If you own an apartment building or thinking about investing in one, there's one tax strategy you must understand. And it's worth your time, even if taxes make your head spin. Today we're talking about cost segregation for apartment buildings, what it is, why many investors overlook it, and how it can meaningfully improve your cash flow from an apartment investment. Let's break it down in simple, real-world terms. First, let's start with the basics most property owners learned in accounting class. When you buy a rental property, the IRS doesn't let you deduct the full cost in the year you buy it. Instead, the cost is recovered over time using depreciation. For apartment buildings, the default schedule is 27.5 years, which means tiny annual deductions compared to the total investment. That slow write-off might make sense on paper, but in reality most parts of an apartment don't last 27.5 years. Flooring wears out faster. Appliances need replacement. Lighting, cabinets, electrical fixtures, HVAC systems, even parking areas and landscaping don't stick around decades. Cost segregation takes advantage of that reality. It's a tax strategy that separates out the shorter-lived components of your apartment building from the long-lived structure so that those parts can be depreciated much faster, often in 5, 7, or 15 years instead of 27.5. That's not guesswork or tax loopholes. The IRS explicitly allows this treatment if you can document it through a cost segregation study, an engineering-driven analysis that identifies, classifies, and supports the new depreciation treatment. So how does this help you? Let's say you purchased an apartment building for $10 million, excluding land. Under the standard 27.5-year schedule, you would take about $363,000 in depreciation deductions each year. But a quality cost segregation study might find that 20 to 40% of the building's depreciable value can be assigned to shorter-lived categories like appliances, unit finishes, certain electrical systems, site improvements, and amenity components. That means instead of deducting only $363,000 per year, you might take $600,000 or more in the early years simply by recognizing these shorter life assets up front. And at a 35% combined federal and state tax rate, that could translate into tens of thousands of dollars in lower tax liability, cash you keep and can put back into the property. That's the core advantage of cost segregation for apartment buildings. Accelerated depreciation, reduced taxable income now, better cash flow now. Now you might be thinking, is this only for big buildings and huge investors? The short answer is no. While cost segregation tends to make the most sense on buildings with substantial depreciable basis, commonly properties above roughly $750,000, apartment buildings of modest size may still benefit depending on your tax situation and strategy. Here's why this strategy is especially powerful for apartment owners. Apartment buildings typically have a higher proportion of short-lived components than many other property types. Think kitchen appliances, unit flooring, cabinetry, plumbing fixtures, interior lighting, clubhouse furnishings, parking lots, walkways, landscaping, and so on. These items wear out faster than the building structure and therefore can be placed in shorter depreciation buckets. This is not just theory. A well-executed cost segregation study produces a detailed IRS-compliant report that provides defensible support for your tax return. It includes narrative detail, asset breakdowns by class life, and recommended adjusted depreciation schedules. These accelerated deductions shine particularly bright when you're in a value-add scenario, such as renovation or major upgrades. If you've recently invested heavily in interior improvements or new amenities, a cost segregation study can accelerate deductions on those costs too, compounding your early year tax benefits. Now let's talk about timing. When to consider a cost segregation study for an apartment. Ideally, you plan for it at acquisition, or just after major renovation costs are known. This gives you the greatest opportunity to align your depreciation strategies with your tax planning right from day one. But it's also not too late if you already own the property. In many cases, cost segregation can be applied retroactively through a change in accounting method using IRS Form 3D-115. That means you might be able to take catch-up depreciation for prior years in one single year, generating a significant deduction now, even if you've owned the property for several years. So whether you're buying, renovating, or simply looking to optimize tax efficiency, cost segregation remains a valuable tool in your planning toolbox. Now, let's talk about something every investor worries about: risk and audit exposure. Cost segregation is widely used and perfectly legal. But the IRS distinguishes between high-quality, engineering-based studies and sloppy analyses that make overly aggressive classification decisions. A professionally engineered study, backed by thorough documentation and credible methodology, is far more defensible than an internal spreadsheet allocation. That's why working with specialists who understand both engineering and tax law is critical to protect your depreciation positions in the event of IRS review. Another point investors often overlook is depreciation recapture upon sale. Accelerating deductions in the early years means you reduce taxable income now, but when you eventually sell, some of the accelerated depreciation may be recaptured as taxable income. That doesn't negate the benefit because of the time value of money, but it's something every investor should model into their exit strategy with their CPA. The net bottom line is this: cost segregation for apartment buildings doesn't change the total amount you can depreciate. It simply changes when you take your deductions. And taking them earlier, when cash is most valuable, is a sophisticated way to enhance your after-tax cash flow and your overall investment returns. If you want to explore this strategy for your own apartment buildings, it starts with the numbers. The smartest first step is to get a free, personalized analysis that estimates how cost segregation could impact your depreciation and cash flow. Visit costsegregationguys.com to request a free property-specific proposal. They focus on engineered, audit-ready studies customized for multifamily and apartment owners. And they work closely with your CPA to integrate findings into your tax reporting. Don't leave tax savings on the table. Understand your options, plan with confidence, and let cost segregation help you make the most of your apartment investments. Thanks for watching.